The reason people take these courses is because the data science of real estate tells you where to invest and when to leave. The part that people often get right is they get right that, okay, this is a good city to invest in. Maybe Dallas is a good city to invest in. The part that they never get right is when is it a good time to leave Dallas?
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with Neal Bawa, who is one of the most well-known syndicators in the real estate business. He's somebody who focuses on multifamily, but also has exposure to some other asset classes such as industrial, mobile home parks, self-storage, build-to-rent communities. And in this episode, clearly we talk about the multifamily side of his business because that's what we talk about in this podcast. But we dive really deep into a couple of specific topics. One being market selection and underwriting markets and evaluating markets. The other being asset management. And then we talk about some current events related topics towards the end as it relates to what Neal is focusing on now in his business and why. And it's a great thesis. So I recommend you stick around and listen to the last 5-10 minutes of this show. But the reason I wanted to have Neal on is he's known in the business as the mad scientist, mad data scientist. And the reason that he earned that nickname is because he's one of the most data-driven investors in the entire business, whether that's selecting markets, underwriting deals, asset managing his properties, organizing his business at a higher level in terms of the business that actually goes out and buys real estate, hiring, tracking success of his teammates. I mean, it's everything that he does is data-driven. There's a significant amount of analysis that is involved in his business as it relates to how they make decisions, much more so than any other investor really in the business that I am familiar with or that I know of. And in this episode, I learned a bunch of different things. I'm sure you're going to learn a bunch of different things as well. You're probably going to take some things away from this episode that you can directly implement in your business. I personally got a lot of value out of how Neal structures his team as it relates to asset managing. There are thousands of units across all kinds of different metros. And I think this is just a really high-level tactical episode for all the investors that are listening. Now, if you learned something in this episode, please consider leaving the podcast a rating and review. And if you're watching this on YouTube, and by the way, we put all the podcasts on YouTube now, link is going to be in the show notes. Please consider subscribing to the YouTube channel and leaving a comment about what you learned and what you enjoyed. But without further ado, I should say, let's get to Neal Bawa. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is Neal Bawa. How are we doing, Neal?
Doing well. How are you?
Doing fantastic. Can't complain at all. Obviously, I just gave a little bit of an intro for you and the other audio recording that I put together here. And I'm sure we're going to be getting into asset management, how you structure your organization, working with overseas talent, some really fun topics here today. Yeah. But why don't we start with your background? Why don't you share a little bit more about what you were doing before real estate, how you found the real estate business, and what you're up to today?
Sounds good. Neal Bawa, I am a technologist, computer science graduate, data scientist by profession, by experience, and was doing technology for a long time until about 2014. Running a company, took it from 10 to 400 employees, helped sell it to a venture capital firm, private equity firm, sorry. And while I was doing that, I was making the big bucks, but I live in California, so I was also paying the big bucks. So, there were years when I was paying 46% of my income in taxes, and real estate basically turned out to be the best way to reduce that number. Started off in real estate in 2003 to build a campus for my company. So I ended up being a developer before I was ever a landlord. And 2009, I started buying single families, and 2014 is finally, after more than a decade, is when I jumped in full time.
Love it. And what segment of the business did you jump into when you actually made that shift?
So I started with single family in 2008. So the first single family that I purchased was in 2008, and then I ended up buying a bunch of them. So a truckload of them for myself and for other family members. And then went to duplexes, triplexes, 7plexes, 12plex, and then basically jumped in all the way into large multifamily. So my first formal syndication was a 237 unit multifamily. Since then, I've done just about everything. I have a large investor database. They're as geeky and nerdy as I am. So about 1,000 of them have given me $300 million, and I've spent that money on value add multifamily, new construction multifamily, build to rent, which is always new construction. There's self-storage, student housing, office, flex industrial. There's a bunch of different asset classes that I've invested in, some new construction, some not. And it's been a very fun and interesting experience to learn about all these different asset classes and deploy money in different ways. And my investors liked the fact that I was having fun with it and were willing to participate in the fun.
Absolutely. No, I mean, there's a lot that we can get into there. I'm going to try and narrow down different components of that journey into some specific topics. But let's start with this. Whether it's you want to go as far back as 2008 or back to 2014 when you really made the leap, either way is fine. But where did you invest at that time? And maybe we can make it specific to multifamily. Where were you investing? Was there a reason for that? Do you still invest there? And has that changed over the last 10 plus years?
Oh, the locations have changed continuously and so here's what I'm going to say this, and I say this a little bit tongue in cheek, Axel. The truth is that I'm very promiscuous when it comes to locations, extremely promiscuous, more so than any syndicator that I know of in the United States. So most syndicators will pick a city. They like this city. Maybe they pick Houston or Dallas. And then the majority of their investments will be in that city. And they'll have, maybe a little bit here and there, usually in the same state or maybe one more state, right? So it's fair to say that the vast majority of most syndicators focus on a given state. Or if they switch states, they might switch once in 5 or 6 years. I am nothing like that. So the reason most people know me, there's about 25,000 people that follow me. There's 12,000 people that have taken one of my courses on the web. And these courses are basically about the data science of real estate. There's a course called Location Magic that is on Udemy, has 1,000 5-star reviews. Right now, I think I have 12,500 people taking it. And the reason people take these courses is because the data science of real estate tells you where to invest and when to leave. The part that people often get right is they get right that, okay, this is a good city to invest in. Maybe Dallas is a good city to invest in. The part that they never get right is when is it a good time to leave Dallas? Because the best time to leave Dallas could be at the peak of the boom. You might still have Dallas growing faster than anywhere else. You might still have Dallas getting more jobs than anybody else. You might still have everything in Dallas going right and prices going up. And that might be the perfect time to leave, right? And that's not something that people understand, that you still should leave metros when they're in the middle of a boom, but whether it's Dallas or Phoenix or Austin. And that's something that I tend to be better than the average investor. Certainly something that I've learned over time that I have a lot to learn there, but I tend to be better than the average investor at doing so. And so you will find that if you go to my website, you'll find that my portfolio is in 10 states with 2 being added, and in 17 different metros. Because what I do is I chase the path of progress before other people know about it. So I've now predicted 3 times, cities as being best cities in the United States to invest in 1 or 2 years before it actually happened. Usually I use the Milken, Milken, Milken. This is an institute that ranks 1,000 cities in the United States on 10 different criteria and basically picks top cities in the US for real estate. And I have picked multiple cities 1 or 2 years before they got the number 1 ranking in there. And that's just data science, right? So I don't have the kind of staff that Milken has, so maybe it takes them a little bit longer to get to where we are. And so to me, what has changed over time, Axel, is that I've realized that no city, no matter how powerful it is going to stay in that sweet spot of investing, which is hot, but not too hot, right? Slightly overpriced, but not too overpriced. No city stays there. And that's why I'm continuously moving.
Love it. That's a hell of an answer. I'm going to have to go check out that resource myself as well, the Milken Institute. That's a great plug. Now, to clarify, when you are investing in let's just continue using multifamily as an example. Are you and your team operating those assets? Are you raising capital for other operators and you're more just deploying capital, mixture of both, or what does the business look like on the back end there?
We don't raise capital for anybody else at this point of time. We have in the past, so 2017, 2018, before that, 2014, 2015, we raised capital for other people and learned by doing so. But the truth is, usually 2, 3, 4, 5 years into your syndication path, you'll stop raising money for other people. If you're doing it right, there's a process, and the equity partnership phase is going to end. You're going to build your own resources. You're going to have your own, director of acquisition and director of development. All of those things will become in-house. You'll have an asset manager or more. In my case, I have currently have 34 employees, of which about 30 are full-time employees. And they work both on the development side of the house as well as on the acquisition side of the house. So it no longer, the math on, being an equity partner no longer works for us and hasn't worked for a while.
Got it. Now, with that being said, because I assume that was the structure based on what I know about you and your company and your business, something that a lot of investors, operators say, and I think this is the reason why folks focus on just a couple of markets, one market, two markets, what have you, is there's an element over time of relationship compounding where you work with the same brokers, the same lenders, the same PM company, what have you. And it gets a little bit easier to find those opportunities in the deals. And obviously you're compounding your knowledge of that market, putting yourself in a position where maybe you're at the front of the line when a deal comes out, or for other components, right? Your market knowledge starts to help you operate assets better, et cetera. Now, in terms of your approach to investing that you described, which is finding these markets before they become hot, before they become, I'll use the word mainstream. I guess maybe that we can loosely apply that here. How do you actually go about developing those relationships? And have you found that that's a challenge that you are facing in just the journey of investing and building your portfolio is maybe starting at an earlier point with some of these relationships and working to build them? I guess maybe talk about that and how you approach that dynamic.
So what you just, what I provided initially were the pros of my approach, right?
Yeah.
So the pros of my approach were, I pick up cities before other people know about them so you can get better pricing, and you basically are catching the city on the up curve. The con was exactly what you mentioned, right? It's hard to build relationship and maintain relationships when you're moving between cities. But for the most part, that all that does is makes the syndicator's job easier. It doesn't make him better syndicators. They just simply have access to more projects, more assets in their given city, right? Or their given state. Usually their given city. In 99% of the cases, it's their given city. So that's just making their job easier. It's not making them a better syndicator. Now, what is making them a better syndicator is knowledge of that city. Now, but let's be honest here. Let's talk about a syndicator that only invests in Dallas. So this syndicator is now learning more about Dallas. Well, Dallas actually has 12 to 15 completely, radically different submarkets. So if Axel is investing in Denton, right, which is sort of on the northeastern side, well, then you now have a very good understanding of the Denton submarket. So if you get another asset in Denton, yes, you have that advantage. You have a market advantage. But the likelihood is your next one is probably going to be in Plano. And then the next one is probably going to be in South Dallas, right? Then it's going to be in Fort Worth, which most people still consider to be part of Dallas. So the truth is, if you look at most syndicators that are single, metro syndicators, the assets are still in 12 different submarkets, so you don't really have that knowledge. I don't believe that it is fair or right to say that some submarket in Dallas is like exactly another submarket, because that simply is not the case. They all have extraordinarily different incomes. They have extraordinary different, occupancy rates. Even their expenses are different, right? Because the people might be coming in from outside the metro if it's at the edge of a metro, and then the incomes, your payroll costs there are cheaper. So to some extent, yes, it's convenient to work in one metro, but there's downsides of that as well. So there's pros and cons of both approaches. It's very important to understand that I'm not saying my approach is any better. I'm simply pointing out that it's different.
No, and I think that's a great distinction. I appreciate you sharing that commentary around that for sure. One last question on just selecting markets, and then we'll move into a different topic. But I think a lot of the folks listening are familiar with the metrics that you want to see when you're evaluating a market. You want to see population growth and job growth, rent growth, et cetera. We want these growth metrics, right? We want a rising tide to lift all boats. But there are some other metrics I think that are maybe not discussed as frequently on podcasts or online or in these types of channels, which is How much supply is being added to the market if you're buying existing product? What does your competition look like? Who are you actually competing with for deals? And what is the environment like in the local marketplace? How do you, I'm trying to think of the best way to ask this, but how do you actually evaluate all of those different components? And maybe a more specific question for you is, obviously you're early to these markets that later become a little bit harder, which is an advantage in and of itself. And you're going to create value just by being early. But is evaluating competition, is evaluating the other individuals that are participating in that market a part of that evaluation, or is it really much more data focused?
So you start with data. You can't end with data, right? So at no point do I suggest that, being a data scientist and understanding and being able to compare 1,000 markets is going to mean that I'm going to pick a magical market where I can just walk in and buy the first asset that I see for some reasonable price and do well. So picking cities and then picking assets are two separate things. And just doing a good job of picking a city doesn't mean that you can do any less of a job in picking the asset. So that's the first thing you have to understand. So the set of metrics for picking cities are very different from the set of metrics for picking properties. So for cities, you mentioned them: job growth, home price growth, income growth, crime reduction, right? And population growth. These are 5 that I look at when I'm picking cities. These days, there is a surprising 6th metric, which now has become more important to me than the others. And I do not believe that you've ever heard of this on a podcast, because so as a data scientist, what we try and do is we try and take everything that we're measuring and we try and compare that with profit, right? And if you do this obsessively over and over thousands of times, you can say things like this: a city with cheap insurance has 1/3 of the impact on your investors' profits as a city with cheap property taxes. Okay. Another way of saying this is property taxes are a much bigger decision maker of what city to pick than insurance, because property taxes have a much bigger impact on net operating income, and your selling price is a multiple of your net operating income. So today, I have a new criteria to pick cities that I didn't have in the last 4, 5, 6 years. It's not even in my course on the web that 12,000 people are taking. And that is the combination of low property taxes and low insurance. Because in the last 3 years, property taxes and insurance in the United States are a black swan event that nobody recognizes. A black swan event occurred in 2020 called COVID. That black swan, that event then led to individual black swan events in a bunch of different markets. For example, work from home, right? So you've got work from home, that's a black swan event, and it's changing the office market. In my mind, the office market is going to go through a 10-year meltdown because of a black swan called work from home, which was really tied back to a black swan called COVID. Well, in the same way, no one is paying attention because they're not looking at data as much as I do, and they're not as obsessed or as nerdy as I am. They're not looking at the impact of what has happened in the last 3 years in terms of property taxes plus insurance, what it has done to the net operating income compared to 3 or 4 years ago. Now, every syndicator is aware of the impact of property taxes and insurance on NOI, right? 100% of them are, right? But 0% of them are changing cities because of it. That's the difference between data science and being syndicators. Data science is now saying that the biggest single factor that is actually affecting my profit today is no longer population growth and job growth. The biggest single factor is a combination of low property taxes and insurance. And not one podcast, not one conference says that.
Mm-hmm. It's a great point.
People catch up with it in the next 3 or 5 years, but they'll catch up with it.
Yeah, I mean, it's the landscape from just in terms of where individuals are electing to invest right now is completely changing as a result of this, with all of the corrections in Houston and throughout Florida and a lot of different coastal markets throughout the country as it relates to what's going on with insurance. We invest in Florida. We own property in Florida. We've sold a lot before really the insurance market started to bust out in Florida. We still own an asset. It's a factor in how we operate that asset now. And it's made us less enthusiastic about buying there as it relates to what's going on from a volatility standpoint, harder to underwrite, harder to actually project what your expense line items are going to be into the future. Florida now becoming a high property tax and extremely high insurance state and getting walloped on both lines. And
these are states that I love, right? So 5 years ago, I was telling people, go to Texas, go to Florida. And what I'm saying today is while Texas and Florida haven't really changed much in terms of demographics, they're still right at the top. The impact of property taxes and insurance is so enormous to the net operating income that they no longer, neither state now features in my list of top 10 states that I would go to if I was focused on the bottom line. And they were easily probably the number one and number two 5 years ago.
Yeah, absolutely. And then contrast that with a market like Arizona. Granted, I don't invest there, so I don't know if you do or not. I don't know, but there is a different dynamic in terms of how property taxes are assessed, right? And there's a little bit more predictability in underwriting assets in that market. So there's a little bit more protection on that side of the P&L. But anyways, this has all been great. So let's dive into asset management, because I know this is a core component of what you like to discuss, and it's something that you guys do well, is asset manage well and operate well. Let's start with this. I'm assuming you work with third-party management companies and all of the different markets that you buy, or do you have that in-house?
We work with third-party property management companies in all of the markets, but we add a layer on top. We call this layer the Efficiency Center. The Efficiency Center has a US-based employee in charge. Her name's Megan, and has 4 people in the Philippines. The job of the Efficiency Center is not to replace the property manager. To be honest, I don't think property managers are replaceable. And I certainly don't think that becoming your own property managers is a good idea. Now, if you're only investing in one metro, I think it's a great idea. If you're jumping, then it's a terrible idea. So given that I'm jumping, I can't really do much with the property managers, and the quality is going to be variable, right? A property manager in Arizona is not going to be the same as Florida. And even within Arizona, they're going to be different depending upon different properties and different groups. So my job is to find a competent property manager and then build a layer on top of them that increases their efficiency, but most importantly, increases their accountability, right? And so instead of building systems to manage a property, we build systems that show us an extremely naked and visible view of just how well every single person that's in the property management team is doing, right? And these dashboards that we have built are daily, weekly, monthly dashboards. In addition, so for example, how, every property manager that is using, let's say, AppFolio knows that AppFolio has two-way texting. So it's, you can text people and they can text back. But I don't know of any syndicators that actually have a dashboard that says what percentage of the time does the person on site, the leasing manager, what percentage of the time do they respond to a text within 5 minutes, within 60 minutes, within 1 day, within 3 days? What percentage of the time do they respond to incoming phone calls within 5 minutes, 1 hour, same day, next day, right? Now take these 2 examples, multiply them by 100, right? Now you build dashboards, and those dashboards are naked to the property manager as well. So we're seeing it, they're seeing it, and they're going, oh, wow. If we said something in our property management contract, we didn't think that these people would actually follow up and check on everything. They're checking on everything. So either I have to do my job right or quit. And our property managers have done both.
I love this. I love including a layer of staff and individuals whose sole job is to focus on accountability. And obviously they're working on some other things, as you mentioned, but specifically in our business, everything that we do with our PMs, it's almost just extreme babysitting. That's kind of a term that I use. It's just making sure that everything that they say they're going to do and making sure that everything they should be doing is being done in the manner that serves us and meets our expectations. Now, let's start with that layer. You mentioned you had one US-based individual, her name being Megan. Shout out Megan. And then you mentioned you had 4 individuals in the Philippines. What is their role? Do they have a specific focus in that overall process? Do they support Megan, or is there some other reasoning there?
They do a bunch of different things that are not even part of asset management. So they have
Gotcha.
other roles as well. On the asset management side, again, I'm going to give you more examples, right? So every syndicator that I know of has a Excel spreadsheet, and this Excel spreadsheet is on unit turns, right? Or maybe it has a tab for unit turns for each property. Well, we have the same thing. We have a tab. But what we also have are dashboards. So one person in the Philippines is very talented with dashboards, right? So that's something that they did before. And we didn't teach them this stuff. We just hired somebody that was extremely good at dashboarding on Google Docs, right? And by the way, there's a phenomenal free Google dashboarding product, which I'm shocked Google has never charged for. That basically allows you to create extraordinarily interactive and beautiful dashboards. These are not just a chart or a graph, right? Because you can do charts and graphs in Google's, Sheets. These are interactive. You can have drop downs. You can say 1 month, 3 month, 1 week, last week, and everything changes, right? And so it's kind of like Tableau, which is a well-known web product. There's even websites built on Tableau, in that you can take all of the data and make the data something that you can change the query on real time. So we have these dashboards that we build, and these dashboards tell us, for example, in the last 30 days, how many units have been turned? What percentage of the time did the property manager actually hit the amount of time that they said? If they said, we're going to take 5 days, did they do that 68% of the time? Did they do it 12% of the time? How much did they run over? And now everyone has this information. But my argument is this, Axel: 99% of the people, because they don't build dashboards, they only use Excel spreadsheets. It takes too long to get to that data for most of it to be of use. So my obsession is, first, gather data, then never show them to your executives. Okay? Only show them dashboards, and make sure that every dashboard is something that you can immediately change. Like, for example, when I want to say, okay, I don't want to look at a week's view. I want to look at a month. I want to look at a quarter. What about the last year? I should be able to do that right there. So every single dashboard should have data from the beginning of the purchase of the property all the way to this week, right? And I should be able to change that without ever needing to go back to people, because decision making is real time. When you're driving a car, the gauges in front of you are called a dashboard, Axel, because you only have 1/10 of 1 second to look at them and look back at the road. If you take 3/10 of a second, there's a chance you'll hit somebody, right? 1/10 of 1 second is the amount of time you have to look down, look back up. I want to apply that to everything that I do and have dashboards, interactive dashboards of everything. This takes a lot of time. This takes a lot of effort, but it massively improves our ability to make decisions, and it massively improves our property managers' ability to see where they're screwing up.
Love it. No, this is great. I'm going to get
huge amount of time. It takes a massive amount of time, by the way.
Yeah, no, I can imagine, right? And obviously it takes time to build this out, and one, to build it out, and two, to actually utilize it on an ongoing basis and to keep it organized, right? I think that's the other components of this. There's developing it, and then there's implementing it over a long period of time and staying consistent and actually utilizing just the fact that you're building this out, right?
And changing the conversation, right? So here's the conversation that most syndicators have. They open an Excel spreadsheet, they go to I'm using unit turns as a tab because everybody does them, right?
Yeah.
So you go there and then you start looking at each line, right? What we've told our team is, we should never, ever in a meeting with a property manager have that conversation. We just want the dashboard, and we start our conversation and end it on the dashboard. The data in the background doesn't matter. It's the insights that matter, right? And that's all we want to look at. So the conversation that we have as an asset manager is at a completely different level than going through a bunch of lines on an Excel spreadsheet.
Yeah, absolutely. Couple of little technical questions as it relates to how you work with all of these different PMs. As you mentioned, PM in Arizona is going to be different than a PM in Florida. Maybe they're both using AppFolio, but owner reports might be different. Communication style might be different. Approach to management, fundamentally speaking, might be different. Is there anything you do early in that process? Or, I would imagine this happens before you even sign a management contract, as it relates to setting the expectations around how you want to be treated and worked with as a client. Do you want access to the back end of their AppFolio? Do you want do you want to hop on a weekly call with them? Like, what do you do to get to try and maybe streamline the relationship you have with different PMs to make it a little bit more consistent from market to market, PM to PM?
We try and maintain the same property management software if we can. So, AppFolio, and so we don't want to have a hodgepodge, but we, on a practical basis, have ended up with a hodgepodge. And so there's a lot of extracting stuff into Google Sheets, then massaging it, cleaning it up, and then connecting it to the dashboard, which is, I think, unavoidable at the scale that we're at. If I was 10 times this size, I would just mandate AppFolio and say nothing else will work, right? I'm not there, but that's our first goal. The second goal is we want an admin or administrative login to AppFolio. Most property managers have trouble giving us that because sometimes we can see other people's data. So we have to work with them to shield other people's data and still give us admin access, which is possible. It's just not something that's set up by default. So you keep asking and asking and asking, and eventually they realize, oh yeah, we can create a new admin login and shield all of our other customers and give you that admin login. So that's part of that process. And it's so you try and make it as kind of down the middle of the fairway as you can. But really the purpose of having so many people in the Philippines is it's really hard to do that. So we are, often on the left side of the fairway in one project, and the right side on the other, and we're in the first cut on another one. And we basically somehow bring it back to the fairway by using brute force manpower.
Love it. And that makes sense. And we're in the same boat. We work with 3 different PMs and we get the admin login so we can pull our reports, and it's a process, but at the end of the day, you have to make do with what you have outside of bringing it all in-house, which, as you mentioned, if you're in multiple different markets, is oftentimes just complete and utter operational drag in your business. Doesn't really make sense. So we talked a lot about data, how you like to organize data, why it's important to organize data. Let's maybe talk about what you're doing on a weekly basis, monthly basis, however often you're doing different things. But from an ongoing asset management standpoint, you close a property, you hop in on weekly calls talking about specific metrics with your PM. Are you doing stuff monthly? Like, what does the ongoing asset management process look like as it relates to successful asset management within your business?
It's weekly if they're hitting their benchmarks, and it's twice a week if they're not. That second meeting is basically a deliberate irritant designed to make the property manager be more irritated. We need them to get into a state of irritation so they can start moving towards their metrics. And then there's a big gain for them, which is they don't need to do that second meeting.
Yeah.
So 1 meeting a week goes up to 2. And we've tried 3 meetings a week with property managers, but at that point, they just quit. So it's not something that we've actually managed to ever achieve. I do not go to property management meetings anymore. I go to an asset dashboard meeting, which is once a month, where I compare multiple asset dashboards with different properties. So the people that are going to the weekly property management meeting are my chief operations officer, Anna, and the asset manager, Megan.
Got it. So let's say Anna and Megan, when they're hopping on these recurring meetings with PMs, what is the main what's the objective in having those meetings? And I'm assuming they're talking about data points, KPIs, something that's more tangible on those meetings. What are the big ones that you guys like to track and that you're talking about when you're speaking with your PMs?
They're no different from anyone else's KPIs. Yep. It is our ability to present the data in an extraordinarily visual and simplistic way that differentiates us. But it's the same sort of things, right? So where's your occupancy? Where's your NTVs? How many units do you anticipate are going to free up? What have you done with rents? Maybe it's a property that's using some kind of rent management software. And of course, we look at unit turns. We look at rehab of outside areas. Where's that going? Budget versus actual. Obviously, in the end, everything comes down to budget versus actual, right? So I don't feel that our conversations are any different from others. I think it's the quality of the conversations that's different because it's so driven by dashboarding.
Got it. And that makes a lot of sense. I know a lot of folks that have recurring asset management calls, but they're not referring back to historical data or current data. It's just feel. It feels like that's been vacant for a while. How long has that unit been vacant for? It feels like we ran over on this or that. And while they know they should be speaking with their PMs regularly, they're not tying it back to trackable metrics that actually dictate whether or not those calls are even productive in a lot of ways. So I think
it's not just looking at the back, right? It's looking at chunks of the back. So imagine you've got some metric, right? So there's a certain metric about, once again, because I've already used it before, the speed at which units are turned, right?
Yep.
So I want to look at a 4-week, a 1 month, a 3-month timeline, but then I don't want to just look at 12 months. I want to look at 3 months, then the 3 months before that, then the 3 months before that, then the 3 months before that, all visually on the same screen. So I can say something like, 9 months ago, you guys were doing really great with unit mix, but whoever you have working on your unit mix, look, every single quarter you've gotten worse. Every single quarter for the last four quarters. The problem is if you don't have that data in front of you, you can't make those statements, so you can't really catch them out.
Yeah. Yeah, it's incredibly important. Now, in terms of just, I want to touch on overseas talent real quick. Where do you typically source talent? Are you directly hiring? Do you work with an agency? I'll probably have a couple follow-ups, but we'll start there.
We've never hired from an agency. We've interviewed agencies and well, maybe we've hired once or twice when we were desperate, but bottom line is we only hire internally. We do not call them virtual assistants. They are team members. In our case, we only hire them on a full-time basis, except if they have some extraordinarily specific talent, which we don't need on a full-time basis. So we have like our Facebook ad specialist is not a full-time person. I think we pay him, 16 hours a week because he only does one thing and he's only good at one thing. So bottom line is that we like to hire everyone on a full-time basis. We like to give them, so we'll spread them across departments. That gives us an enormous amount of control over them. We only hire in the Philippines. For the most part, we only hire women. And we force them to work our hours. They are never given any flex time. So they work either 8 to 5 East Coast or 8 to 5 Pacific, depending upon what team they're part of. So we tell them it's a work from home job, but there's no flexibility. And then we have a huge amount of software to monitor them. So Big Brother is not a thing in the Philippines. They're just used to it. It's okay. Culturally, they're fine with that. So while we don't track our US employees from a Big Brother perspective because half of them would quit, we don't have any such issues with the Philippines because culturally it's okay.
Got it. Makes a lot of sense. I know we're coming up on our time, and I want to talk about current state of the market stuff and what you're doing in your business to either prepare or capitalize or to just maintain properties that you already own. We're recording this mid-November, so I think this is going to be up late November, early December. So this is going to be very relevant for when this episode releases. Let's just start here. What are you currently focusing on as a business? So I guess, are we looking at multifamily? We're looking at a different asset class. If so, once we get into asset class, what specifically are you looking for within that asset class? And then we'll go from there.
Right now I'm focused on build to rent. BTR is a word that has changed over time because if you build anything to rent, technically it's apartments, right? Build to rent. Mm-hmm. So BTR actually means townhomes or single family properties to rent, right? So it's not apartments. I believe that what is happening is in the last so the people in America, 66% of Americans live in their own homes and 33% rent, right? The 33% that used to be traditional renters had low income. And so the apartments were the only option for them. Now things are changing. If you look at the millennials, a lot of them have 60, 70, 80, $90,000 in income, still cannot afford a starter home because interest rates have gone from 3% 25 months ago to 7.5% today. So that massively increases your mortgage. And then home prices, shockingly, in the last 12 months are still up 1.8%. They should be down. There's no way home prices should be up when you've gotten interest rates that have gone from 3 to 7.5%, but it's still happening because of the lock-in effect. Tens of millions of homes are locked in under 4%. So home prices went up 1.8% according to Zillow in the last 12 months. So one, they're getting hit by prices, which have gone up 46% since COVID started. Now, two, mortgages, interest rates have more than doubled. So now you have this group of between 6 and 18 million American families, two different statistics, so I'm going to give you both, that will never buy a home, that are forever marooned from home ownership, but they actually make too much money to go and live in an apartment. And so their third option is a new asset class called build to rent, which I believe will eventually become somewhere around 5 to 10% of all apartments. There are 20 million apartments in the Yardi Matrix and CoStar database. 5% of that is a million. 10% of that is 2 million. So 1 million to 2 million units of mostly townhomes. Some single family in certain markets is possible, but really most BTR that's being built now is being pivoted towards townhomes. There's going to be 1 million to 2 million townhomes that we're going to need in the next 10 years for this in-between group, especially the ones that have families. My goal is to build 10,000 of those exactly. And I've created a company called Mission 10K, mission10k.com. Check it out. And I'm building, you'll see one of our BTR communities there. And my goal is to build 10,000 of these. And I'm actually going to create a consortium of syndicators. I happen to know almost every syndicator in America. I'm going to create a consortium of syndicators to take down individual projects. I've raised $50 million to start this dream. And I have a large team that is currently making offers in 8 metros across the United States. We will have 40 projects ready to go within the next 12 months. That's my mission. That's my goal. Mission 10K.
Love it. I'm very happy that you broke it down with data there and talked about the specific number of apartments comparatively to the specific number of homes because I agree with you. The transition for a lot of folks that are looking to, you have a husband, wife, they have a kid, they're looking to move out of their apartment in the city, can't really buy a home in the suburbs. What are the options here? Let's go rent a house, right? There's an increasingly growing number of individuals that find themselves in that situation, but it seems as if the supply and the stock of those specific types of properties to rent is significantly lacking, especially given the dynamics that
Extremely
are around
lacking, and also
today.
expensive, right? So the cost there is crazy. In one of the cities that I've built to rent, I've got rents in the 1650 range for a brand new townhome with granite countertops, 9-foot ceilings, and it's $1,650. You can go somewhere else to the boonies in that city, pay $400 more, and rent a 100-year-old house.
Yeah,
those are your options.
Share a wall with a neighbor or go do that. It's oftentimes a very clear decision for a lot of the folks that are in that position.
And not everybody likes my decision. There are people who are like, no, I still want the single family. I still want the bigger yard. And I don't mind going to the boonies and I'll pay $400 more. More power to you, right? But what about the people that are like, no, I want to be next to the Starbucks. The project I'm talking about, the next building is Starbucks, right? They're like, no, I want to be in the middle of town and I'm okay with sharing walls on either side. I still want a backyard. I don't want anybody above me. I don't want noise. And I'm okay with sharing 2 walls. That's really what a townhome is. The difference between a townhome and a single family home is 2 of the walls are shared. There's never anybody above you, right? And that I believe is 10% of the multifamily stock 10 years from now. And my inspiration comes from my travels throughout Europe. This kind of product is ever present in any European country.
100%.
They came to that conclusion before us because they ran out of usable land before us.
And this is a trend that's only going to continue, right? I'm 29 years old, right? I think my age group, folks that are 27 to 35 or whatever, add a few years into the top end, bottom end of that range. When this group of individuals is moving out of the city, we're looking to stay within relative proximity to cities versus completely exit that type of environment. Right. And we're okay with sharing 2 walls, but it's better than having, call it an 800 square foot 2-bedroom apartment where you just had a baby and next thing you know, you're scrambling to try and find the next solution. Financially, you can't buy. Probably doesn't make sense for you to continue renting an apartment, but you'd love to rent something that sits in the middle of that, where maybe you have a small yard for your dog, but you can still drive or walk to some relatively dense area. So I totally agree. I'm all in on the thesis of build to rent. I think it's a great asset class to be focusing on. Now that's
and it's very new. Yeah. I mean, I'm in the first 4 years of build to rent as an asset class, and I want to get to the point where I'm building 2,000 units 10 years from now, and I'm on my way, right? And so again, if you look at mission10k.com, you'll see just how astonishing this asset class is, and it's very different from apartments. When I build apartments today, I have an infinity pool, I have a gym, I have a big clubhouse, but that's the apartment thing, right?
Yep.
When I build to rent, I have no gym, no pool, no clubhouse, right? The amenity is the townhome. The townhome is the amenity.
Yes. And some level of maybe a yard, right? Where you have some.
Yeah, there's usually like a small yard or a dog park, but I'm not spending dollars on amenities, right? Green space, sure. I'll give you green space because I also need retention ponds for drainage. So I turn that into a green space, but it's really a retention pond. So bottom line is green space, sure. But I won't spend money on amenities because what I'm doing is I'm replacing that starter single family home. And I've never seen a starter single family home with a pool, a gym, and a clubhouse.
No, that's exactly. You're speaking to different objectives. These are different residents, tenants, and customers, fundamentally speaking. They're not there's maybe a small overlap in the Venn diagram, but they're fundamentally looking for different things, which obviously you're solving for when you're building one or the other. So I think that's great. Now, I want to get you out of here on time. Why don't you share, obviously you mentioned mission10k.com, which we'll link in the show notes, but how else can folks learn more about what you have going on and reach out to you?
We love doing webinars. We don't charge for education. We don't have a subscription. We basically never want to charge for education at all, but we love doing webinars. We do 12 of them. 25,000 people sign up for these webinars. And they're all stored at multifamilyu.com, multifamilyu.com. We do webinars on multifamily, other forms of real estate, in upcoming distress. So the next one is called Distress Watch. We also do them on other interesting things like climate change, oil. We do them on artificial intelligence. It's just the things that catch our attention as data scientists that are trends that may somehow connect back to real estate. And all of this is stored at multifamilyu.com. There's never a subscription.
Love it. That'll be in the show notes for everybody that is listening. And Neal, this was great. I appreciate you taking the time. I know we touched on a lot of great stuff. I'm sure a lot of folks listening are going to get a lot out of this episode. So thanks again.
Thanks for having me on the show. Bye, Axel.